When I think back to all the times that I could have either done an investment, or I could have acquired an investment, or I could have invested in something or bought something, or, just done something where I needed money. And at that point in time, I couldn't afford it. I think all the ways that having the knowledge that I have today has benefited me and has helped me to grow, has helped me to make a difference in all the things it is that I've tried to do or I'm currently doing. And when I think and I listen to people say, I don't know how to do this, sometimes I get carried away by the fact that I know it. That's why I probably can advise on it very easily, or I can talk about it very easily. But if you are somebody who has struggled, or you are wondering how it is and you're going to be able to invest in your next real estate deal, then this episode is for you, because I'm going to be spilling all the beans, all the information that I know right now about how it is that you can finance your next real estate investment deal. When I wrote my first book, which was talking about how it is that you can get invested in real estate, how you can make real estate work for you, the most recurring question that came back from everyone who read that book was, how do I start? How do I get the money to be able to, to invest in real estate? And at the time when I was writing the book, I felt that the biggest problem was knowing that you should start or how to start, forgetting that the money was also going to be a very key component for a lot of people, like myself inclusive. I came into the industry assuming that people had the money and they didn't just know how to go about it best. But that very quickly changed when my book came out, and I had a lot of people coming back to say, okay, so we understand this, but how do we get it done? And along the line, I had always had people who would say, oh, I can't afford this right now, and can't afford it and not having the money were two different things, meant two different things to me, because then I would just hear that, okay, you had the money when you were doing something else with it. But the truth of the matter is that not everybody can have the money. And even if you do have the money, you may just not be able to afford it, but you want to do it. In being able to finance your real estate investments, there are multiple options in it that you can actually explore. You can explore them either as an individual, a salary earner, or even just a regular investor. And knowing which one it is that's going to work for you would first of all start with who it is that you are. Who it is that you are when you're coming into the investment cycle, who it is that you are when you're trying to get on the property ladder. And all of those details are what it is that you can look out for. Please stay tuned to this video. My name is Lerato Lekena-Okoro, and I'm a realtor based in Lagos, Nigeria. I've helped clients for almost a decade to be able to acquire real estate, invest in real estate, make real estate work for them. And I hope that as we go along on this journey, starting now when you're watching this video, we can at least start to help you to achieve a similar or the same goal. So let's get started. Now, you remember how I said that the first thing that you need to be able to do is to define who you are in the entire equation. Who you are in the sense that, are you coming in as someone who wants to own property? Are you coming in as someone who is just coming to invest in property? Or are you coming in as someone who just wants to acquire property? Are you a salary earner? Are you a business owner? Are you, who are you? And this is one question that you have to answer for yourself, and also to whoever it is that you're going to be working with. If you're coming into the equation, expect that you are going to have to answer that question. And the reason why that question is very important is because different terms would have to apply to different people. Somebody who is a salary earner would then be eligible for a monthly deduction. Somebody who is a business owner may not necessarily be wanting to be tied to a monthly deduction, but have like a milestone payment plan or a milestone financial plan. And these are the things that at the end of this video that you are going to be able to assess, analyze, and answer for yourself, so that you also can start the process, even if you're not working with a consultant. But if you are going to be working with a consultant, a broker, or an agent, then understanding this process is only going to make the entire process easier and simpler for you to even understand as you go through it. So number one, You have to be able to know, analyze, and understand what the deal is. If you don't have a good deal, chances of you getting financing or being able to work up the money or being able to justify why you should get the money are going to be close to zero. Every deal can be good. Every deal can make money. However, it may not be good for you. And I'll explain what that means. If you're someone who is looking for cash flow, and then you bring a deal that is going to basically accrue appreciation over a period of time, which means that probably you're getting a landed deal, or you're getting a deal that's not necessarily going to be able to be put to work in the immediate, so you're not going to earn cash flow, but you would be getting equity over time. That already is a red flag. A red flag in the sense that it's a red flag in terms of what it is that you want to be able to achieve. Because if what you want to be able to achieve is not going to be achieved, then it's not going to be a good deal for you. I mean, I'm sure that you would agree with me in that regard. Because what you want is cash flow. If what I'm then offering to you is going to be equity, appreciation over time, then you are going to struggle with it. You're going to find it difficult. So the first thing that you need to start with would be finding a good deal. Find a deal that works for your goals. Find a deal that works for what it is that you need. Find a deal that works in terms of the numbers, because the numbers are never gonna lie. And make sure that as much as possible, you can at least bring it down to something relatively close to reality, so that even when reality actually strikes, because reality will happen, things will happen, and where those things happen, that at least you can work the deal in such a way that you will get outcomes that are as close as possible to that one, and then you can make them work for you. And at least you know that you're not losing your money, but at least you're having to modify the returns, so that money is going to be able to work out for you. So that answers know the deal. Make sure that you're getting a good deal. What is number 2? Who can guess? The next factor that you want to be able to lock down would be knowing what options are available and what options are open to you. Now, in the beginning, it's also about how it is that you're coming into the deal. That is very key, because how you come into the deal would also determine, out of all the options that are available on the market, which options are actually available to you. The options that are available to you, that would apply to your deal, that would apply to your circumstance, would always vary. And it's never going to be a one-size-fits-all, unless you and the next person have literally all the terms the same. Whatever it is that you are, chances are that there will still be certain differences between you and the next person that is going to come into it. So even though you're going to probably all going to take the same option or look into the same options, there may be a few differences, and those few differences will come out in the actual specifics of what your model is going to have to be. So why am I talking about all of these things? I'm talking about all of these theoretical factors before we start going into the actual details of what it is or how it is and the ways it is that you can finance your next deal, because these details matter. So again, depending on who you are, that will determine what it is that I'm able to proffer for you. So as somebody who's going to come and say, I want a mortgage, a number of times the mortgage that you think that you want is not what's going to be the best in your best interest. You may also be able to apply for construction finance. So the modalities and the actual specific details of what it is, of how it is that you're going to be able to finance your deal would still be dependent on who you are, what you are, what details are specific to you. So you need to be able to understand these things before you even think about, okay, I want to be able to finance my deal. I want to go looking out for how it is that I can finance my deal. Now, the third factor that you want to also look out for would be what is legal to you. This would rest upon the property itself. What is your property? What detail does your property have? What legal structure, what legal backing, title does your property have? Where is your property located? What are the chances that your property is going to be able to sustain this deal? These are all the things that you are going to have to think about and you're going to have to consider to be able to access or determine which way it is that you're going to be able to finance your next deal. So let's now go into the actual meat, the thing that you have been waiting for, and talk about the different ways it is that you can finance your next real estate investment deal. The first way that, and this is one way that a lot of people are, I'd say, almost mostly conversant with, not necessarily going to be their favorite because of different reasons I'm not going to get into today, but first one would be opting for an off-plan. Now, an off-plan gives you time. An off-plan gives you space. It gives you a bit of flexibility. However, this time is also limited because depending on when it is that you get into the deal, when it is that you subscribe to the opportunity, the timeline that you have may not be as extended as you want. I've had instances where we'll be talking about, an off-plan will give you time, and then the client comes in and says, as much as 3 years? Nope, because it doesn't, many developers are not open to that. Those that will be open to that would probably not be irregular developments. And again, a lot of you buyers want to be able to subscribe to a plan, and then you want to be able to move in, and then you want to be able to keep paying it. A regular developer finance offer is not going to be able to cover for that, which means that in that kind of instance, you are going to have to look for a stopgap where you are either taking on the mortgage or you're getting a means that you can cover up for that payment before you move into the house. Unfortunately, the Nigerian players are not yet that buoyant to be able to allow for that kind of arrangement. And I'm saying this as at the time that I'm recording this video. Maybe this is going to change in the next few months or the next few years. I mean, I don't know when you're going to be watching this video, but if you're watching it right now in year 2023, then yes, the Nigerian players are not yet as buoyant to be able to allow for extensive payment plans or payment periods where you are in the house and then you're still paying for your property for as long as a year or 2 years thereafter without you having completed the payments. Now, in that instance, if that is what it is that you're looking for, then you would have to opt for a mortgage. Now, a mortgage is also similar in the sense that you are also going to have time. But with a mortgage, there is going to be an interest payment that is due every month on whatever it is that your total outstanding payment is, which we would be calling a principal. And with a mortgage, you could pay for as long as 15 years, 20 years, especially if your age at the time that you're going to be completing the payment is not above 55, 60. I advise my clients to stay below 55 so that you at least have some time because you're not paying for your debt all the way up till your full retirement stage. You can at least have some room for extra savings and all. But then you would have to be going for a mortgage if that's your situation. And with a mortgage, you would then be having to apply for it through the finance house, the housing fund, or even just a mortgage financier. There is quite a lot of paperwork that would have to go into that, but I mean, the requirements are there and the potential is there if that's going to be one way that you would like to finance your real estate deal. Now, next up is an option that I kind of like because it also gives a lot of room for multiple advantages, and this one is called construction financing. Construction financing means that you as either an individual, a developer, or a group of people would be able to approach a finance house, a mortgage house, and say, or financial institution, and say that you have this property, which could be just land that is in your name or in the name of one of the parties. And then you would say, we want to get financing to develop this. Now, what that does for you is that it gives you the money without you having to rely on any one person at any particular point in time, which also removes some of the doubts where people say, oh, but if I'm developing with 3 other people, then how am I sure that each one of them is going to be able to pay on time? Construction financing takes away that uncertainty from the equation, which means that as long as your construction is going to time, your developer is found not wanting, your deep plans are in place, you have the land that you're going through, then yes, then financing can come in, and then each one of you are going to have to start working to repay on that financing deal. Now, another thing that I like to highlight, where this is where a construction finance is different from a mortgage, is the fact that where a mortgage you could pay for up to 15, 20 years, and all construction finance does not go past 5 to 7, 10 years. So you have a shorter period of time to be able to pay for it. The requirements would always be different. The details that would have to apply in terms of your evaluation would be different. And most importantly, the interest that you're going to pay is also going to be different, because remember, now we're dealing with not one person, maybe not even two people or two parties, but maybe a couple of parties. So that means that the work that's going to be done is going to be more. So definitely your interest is going to be different. So if you want to go the route of a construction finance, then I assure you, you'd have to ensure that your numbers are high, and you know that everybody who's interested in it is going to be as committed as you are to the entire process and see it to the end. If at any point in time, one of you should get distracted or get disrupted from staying to the plan, then chances are that, the rest of you that remain are going to have to be the ones that are in there. So this is also one reason why this is a financing option that is always preferably given to developers or with the developer in play, so that the developer can also, put their own interest, their own effort into being able to keep the deal on track, because they will then become a third party that would always be working on the deal. Another option that exists for you would be you look into your money or look into other people's money. And if you've been following me for a while, then you would know that I have been talking quite a lot about something called co-investing. Co-investing requires, gives the opportunity where you and a couple of friends are able to come together and use it to invest in property. Now, you may be wondering, how does co-investing work that I can then use it for my own property? I'm going to explain 2 ways that you can use co-investing to achieve the goal of 1, investing in property as an investment, and 2, investing in property or acquiring property that you would use at your personal home. So first off, let's start with you using co-investment as a way to finance your real estate investment goal. Now, with co-investment, what happens is that you and a bulk of people, either people you know, or if you're subscribing to a co-investment platform, community, or initiative like what I am in the Real Estate Dominoes, is that in any of those chances, what you would be doing would be investing in a real estate business that ensures and guarantees that each one of you who's invested in there is actually going to be getting returns for your money by making sure that the property is put to work. Putting the property to work means that none of you is going to be able to live in it. None of you is going to be able to lay some kind of rights to say, oh, this is my house, this is my flat, this is my this. However it is, for all of you, because all of you are going to be co-investors to the percentage that it is that you have invested in it financially. So if the cost of the property is going to be, say, 50 million, for example, then each one of you who has invested in to make up that 50 million at whatever percentage it is that you would have keyed into would all be owners of the property. So yes, you can go on and say, oh, I'm a landlord, I'm a property owner, I'm at this. Yes, you can say that. However, you cannot lay claim to it and say you're going to live in it, because if you live in it, then that means you have to pay every other person for their own share of the investment that is in there. So I hope that explains that part. Now, if you're going to do co-investing as a way to finance your investments, that may be one way to go, especially if you don't have all the money, you don't want to be responsible for the property, you don't want to be responsible for the investment, You want something that is earning money for you on the side, you know? You know how we invest in shares and we just put the money there and then from time to time they come and they pay us? Then co-investment is going to be one thing that you would be considering to do if you want to be for real estate. And I mean, all the legalities for how it would work in terms of shares would and should apply on a large extent to all of this, which means that you'll need to put your money in, you're going to get documentation that says that you have invested in it, and then you are going to have to expect to get updates, to get feedback, to get information about how the investment is doing, and also get your returns, which will come to you as dividends per time, or whatever it is that they're going to call it. Now, if you're going to look at it in terms of how it is that you can use co-investment to finance for your own property, maybe a home that you want to stay in, then that is slightly different, because in this instance, all of you who are either there to be invested or those of you who would be involved in the transaction are always going to have to make sure that you have something to be able to give to each party at any point in time. So there you have my practical and theoretical ways in which you can finance real estate investments or assets easily. I'm gonna have to stop the video here because the next strategy that you can use co-investment for is a bit tricky, and to just add it to the end of this video feels like in service. So it's gonna be a standalone video which would come out subsequently, maybe the next week or something, but just watch out for it. If you are not yet subscribed to the channel, now would be a very good time in which you can do that. So hit the like button if you found value with this video, most especially just as you hit the like button. Also leave a comment down below and share what it is that you've liked about the video, or what it is that you found interesting, or even just highlight what it was. I mean, one point it was that you weren't hearing for the first time, you know, or you were able to understand it in much more detail. And watch out for the next episode, which is going to break down the other way that you can use co-investing to literally finance for the whole. Yes. So till next time, adios.